Yeah, looking at the market at the moment, it's obviously changed a lot from 12 months ago and 18 months ago, and I believe it's all come down to finance, and finance is obviously getting tougher and affecting the prices out there. However, there's a lot of markets that haven't necessarily had the growth, like there's the inner market and the outer market. So if we go back 10 years ago, we had a mining boom, but Sydney wasn't, the greatest sort of market, and I'm not a fan of going into mining towns and commodity-based places, but I'm starting to see a bit of a recovery in those sort of markets. And personally, my pick.
So you would be looking at mining towns at the moment?
Potentially.
I know some people are really badly stung in the last boom in Queensland and WA.
That's why I stay clear from them. But what I'm seeing is a lot of these mining town areas are starting to open back up, and I'm starting to see rents rising, stuff like that. So it's just an interesting time out there in the marketplace, and I think that some of those people that got hard done by in the last market in the mining boom could have the opportunity to get out and sort of recover some of their losses in this market. But my favourite market throughout the whole of Australia is Queensland. I think that it's the most undervalued place. You can pick up properties for still 150, 160,000 to rent for $250 per week. So and that's in the Gold Coast and Brisbane. So.
Right, in that sort of corridor between the Gold Coast and we've seen a few around Springwood and stuff. We've covered some auctions here recently, and we've seen them. They've sort of ones that have gone for like 220,000, but they're renting for $350 a week, and
exactly.
That's a great yield, isn't it? And sort of one you'd never get in Melbourne or Sydney at the moment.
Of course, I remember back in the day, people used to say I was crazy buying out in Mount Druitt and Western Sydney and all that sort of stuff. And I was picking up for those prices back then, and at the time it seemed impossible that the price would ever go to $500,000, let alone the prices that they are now. Yeah.
Look, people are watching and hearing your story, and they're all probably going, "Oh my gosh, like a success story." And the market is different.
Yeah.
For people watching, how much money do you need to start getting into creating a property portfolio?
That's probably the biggest myth out there. Like, people think they need $500,000 or $250,000 or whatever to, probably not $500,000 to get in, but they think they need to get a 20% deposit on $1 million property to get in the Sydney market. For me, I remember when I moved into my principal place of residence, I thought to myself, I've got 150 properties and I've never owned a house to live in myself, and I used property investing as a way to get in the market. And if you were to buy a property for $200,000 and put down a 20% deposit, that's $40,000 that you need to get into the property. It's not too hard to get that, like whether it's working a second job, getting a side hustle, getting Uber driving, whatever the case may be. So, entry point to the market, probably the cheapest, I'd say it'd be like 20 to 30 grand, just depending on the type of property and what sort of lending you wanted to use. I always personally like using 20% deposits, so the bigger the deposit, the better, and obviously for the banks it's more attractive.
Is that why? Because the bank likes it more?
Exactly, and as well as if you want to refinance the property to pull out some equity, it gives you a better potential to, go back to the bank and get the equity out, because if you're using a 5% deposit or a 10% deposit, it's more constraining to you. So, but it just depends on one situation, if they and what they're trying to achieve. You could get in for a 5% deposit, but the finance market is getting much tougher. That's probably 90% of the problems out there in the current market. So
what's the forecast then? If you start with sort of a $200,000 property that you've put $40,000 on, you'd advise you just hold that one and then borrow against it for the next one and the next one. And do people need to expand that much? What's a good sized portfolio?
It all comes down to one's personal position and their goals and what they're trying to achieve. Obviously, for me, when I first started, there was limited resources, and I wanted to have 10 properties. I was 18 years old when I bought my first property, and I thought if I could have 10 properties by the age of 30, that'd be amazing. And I thought it was impossible, but I did whatever I could to get there. And my plan was just to put down a 20% deposit each time and just work real hard until I realised the power of leverage and being able to buy a property below market value where I can get the equity back out of it and replicate the process. So for me, looking at it, I wanted to have 10 properties. If you had 10 $200,000 properties and they all doubled and took through a market cycle, if they had a cash flow that looked after himself as well, you could turn $2 million worth of holdings into $4 million worth of property portfolio. If you sold off half of that when the market goes up, you can pay out your debt, or you can use that equity or sell them all off, or choose what your options are. It just gives you options, and
And obviously you're doing that figure to make it simple for everyone to follow. You're doing the $200,000 figure on 10 properties. with the leverage and what you can do with that, as opposed to, for example, $2 million property. And then you're stuck with all your eggs in one basket, so they say.
Exactly. So if the market goes bad in that one location, you'll have all your risk in that one location. Cash flow, if I have one tenant move out, I've still got 9 tenants with rental income coming through. And it's just a less riskier sort of strategy. And generally, to see a $2 million property go up to $4 million is a harder thing to see from a 200 property to a 400K property. So, it's just I look at it from just mathematics on an equation. The property is just the vehicle for my investing. When I invest, I'm an investor. I'd call myself, everyone says, Nathan, you're a property investor. I call myself just an investor, but property is my favourite go-to vehicle in order to build wealth. And, it's been a fabulous journey over the last 15 years, and the things that I set out to achieve, I thought they were impossible, and then you push forward and just keep dragging the.
I want to ask, you mentioned we just mentioned mining, and Sophie asked about the mining, and now would you look at it or wouldn't you? What about houses versus units? For people to get into, is units a good thing because of price point, or what's your view on that?
Yeah, so for me, when I first started investing, I thought, the old adage of people coming in and saying, buy a house, the land appreciates, the house depreciates, so on and so forth. And I realised after I had about 4 or 5 properties that I would be stuck, like my cash flow was getting very negative and all those sorts of things. And I realised if I'm going to buy another property, I need to buy a unit or a townhouse because the numbers worked out better. And as I started accumulating, strata titled properties that were units, townhouses, villas and so on, I realised that the returns that I had looking back were probably greater on those strata type of properties because I could accumulate a larger amount of wealth because the cash flow position is much greater. People get scared of, paying strata fees and stuff like that. But if you have a house, you have to pay a lot more land tax. You have to pay insurances, maintenance, and you have to worry about the gutters on the property, the driveway cracking it in a strata type property. These things are all sort of covered via the body corporate, so you're only paying a very small portion of that going to the expense. So for me, there was a point once when I had 100% of my properties were houses. It did turn to a point where I had about 70% of my properties were strata titled properties. And today, probably a balance of about 50-50. I realised that each sort of chapter of my investing career that I've gone through, I've sort of needed to navigate through the banks, because we were talking about the banks beforehand. If it wasn't for finance being a hurdle at every step along the way, I'd be sitting here saying I've got 1,000 properties, but it's always, 50% of it is the property, but the other 50% is the financing and getting the finance right, because if you can't fund your goals, then you can't achieve them. And for me, it's something that each time I've sort of come up to roadblocks. Like you might need today to have equity, you may need to have cash flow later for the banks to service your debts, and it's important to understand, I guess, how the banks work from the back end to give them what they need from the front end for the properties that you're acquiring. So what I mean by that is that I've bought in Sydney, and then I've gone to some other areas more for cash flow, then I've gone back to more balanced type of properties. Recently I've been buying land banking for development of the future, so a lot of acreage properties and stuff like that.